of 5% before we get through the summer. I don't know if you also realize that right now, food costs are up 13.7%. Energy bills are up 33%,
Yes.
which is just unbelievable and unprecedented in our time frame. So we have inflation right now at 7.5%. Obviously, the Fed has to take the rates up. We have to, otherwise we'll have something called stagnation. Now, I don't remember stagnation. My older siblings have told me about stagnation. I remember my first mortgage, I complained it was 9%, and one of my siblings proceeded to tell me their first mortgage rate was 21% in the 70s. So needless to say, I did not have a lot of support and love coming from the family on a 9% mortgage at that time. Well, one of the really good things that is going on right now, as always, is the United States Small Business Administration, Paul. Those loans are here to help the small business owner. And even though rates are going up, there's a lot of the programs that really still truly benefit that small business owner. I don't know if you realize, but since 1953, the United States Small Business Administration has been in play. The very first SBA loan was a working capital loan to help a small business owner manage their operational cash flow. And the biggest thing about the SBA programs are their terms. So if you need a equipment loan, all right, let's talk about an equipment loan. If you were doing a lease, you'd have 36 months, right? Maybe a bank would give you 5 years on it. You can actually take an equipment loan up a full 10 years under the SBA 7A or their SBA Express loans. Okay, so you're getting 10 years to spread out that payment, which helps your operational cash flow with the needs of your business. But what's even more important is if you do an equipment loan and you have a remaining useful life of more than 10 years on that equipment, let's say you're manufacturing equipment, and we do this under the SBA 504 program, you can take that over 20 years or 25 years, depending upon the useful remaining life of the equipment. So think about that. Now you've really taken a large piece of equipment and you have really spread those payments out.
Yes.
The same that you can do with owner-occupied commercial real estate. So the SBA is very specific about this under any of the programs. Your owner-occupied commercial or industrial space, okay, so you have to be 51% owner-occupied. So what does that mean? That means if you have a building, let's take the old the buildings down on Halstead, the multi-use where, you have the first floor is the restaurant, there's a basement, and then maybe above it there's 1 or 2 apartments. On a multi-use property such as that, a restaurant would occupy the whole first floor and the basement for all their supplies. That building would be 67% owner-occupied and have a zoning of multi-use. So that type of a property is acceptable to the SBA. There is one thing that's really key right now under the SBA's SOPs, Standard Operating Procedures. When you have an appraisal, you have to be 51% owner-occupied per PIN. So in other words, if you have a building that has multiple PINs and you have a tenant who has 1 PIN, because let's face it, a lot of times your landowners want to identify the cost associated with just that location, you don't have an owner-occupied building because you have to be owner-occupied per PIN, property identification number. So that's really important to understand. But let's get back to the rates. So let's say you have a variable rate loan right now on your line of credit at a bank. Well, what you could do is you can go to an SBA lender who does the SBA 7A lending. They can term out your existing loan and give you a fresh line of credit. Okay, so now you're taking that line of credit right now that may have been inching up, and now you've termed it out. Now, there are a lot of players in the market recently that do fixed 7A lending. Live Oaks Bank, Chase, Fifth Third, Wells Fargo, U.S. Bank. See, normally under the SBA 7A, that is a variable rate program based on prime plus 275 at the high side. Doesn't mean the bank has to charge 275 against the prime, but that's the ceiling. That's as high as they can go. So if you can get a 7A loan with a fixed rate onto it, which the 7A is the most versatile of the SBA programs, it does everything. Lines of credit, it does business acquisitions where maybe there's minimal collateral and a lot of goodwill. And the SBA 504 program, which is the fixed rate program, is predominantly what we call the fixed assets, big pieces of equipment and buildings, owner-occupied buildings. But in this increased rate scenario, the SBA 504 program has recently come out with new debt refinancing programs. So Paul, for the first time ever, the SBA 504 loan can refinance out a 7A or another SBA 504 loan. So in other words, it can,
That's unusual.
it's unusual that you can take a government guaranteed loan and refinance out another one. Now, under the SBA 7A loan, you always could refinance a 7A loan with a 7A or use the 7A to refinance the 504. But the SBA 504 is just the first time ever that it can refinance out its own 504 or a 7A. But let me explain, on the SBA 7A refinancing into a 504 loan, it's based on the use of proceeds. And it's got to be eligible use of proceeds. So what are use of proceeds that are eligible under the 504? Purchasing of a building, renovations to that building, the parking lot, large pieces of equipment. What is not eligible is if you used it for big pieces of working capital, okay? Because that really does have to still go under the 7A loan or the 5 or the the express loan. So what's nice too about these SBA programs is you can put them together. So if you're a shop that does the SBA cap line, which is the equivalent to a line of credit at a bank, but you have that government guarantee behind it, you can advance up to 80% of eligible accounts receivable and 50% of inventory, and take a 504 loan and refinance your building. So now you've refinanced your building into a fixed rate loan for 20 to 25 years, and you still got a line of credit that's going to help you with permanent working capital that you need, or as your operational needs are. You could also, I'm sorry, Paul.
Let's rewind for just a second and consider the buyer corporation of another business, or the buyer individual, maybe family office, maybe small private equity company. They want to buy a corporation. What are the basic fundamentals of their eligibility requirement just to get in the door to talk with you? If somebody wants to buy a business but are uninformed as to what they need to be credentialed with, could you touch on that for just a minute?
Sure. So if you're going to be buying if one business is buying another business, there's a few things that you're going to need to know. First and foremost, what is the purchase price? Has there been a business valuation done of the business? What kind of assets are with the business? Are there buildings? Are there equipment? Or is it all just receivables and inventory and goodwill? Okay, those are going to kind of determine which SBA program you're going to be using. Okay. Also, any owner with a 20% more ownership interest has to provide a unlimited guarantee under the SBA program. Okay, that's going to be very important. Your structure of that business acquisition, okay, is it an asset sale? Is it a stock sale? Okay, that's important to know, because that will also drive which program we can use. Is there a seller's note? Is the buyer coming to the table with any true cash? In other words, what we call in the banking world, skin in the game, right? Skin in the game. Okay.
That's right.
You know, and that's really important, because the SBA has now mandated that 10% of the equity injection into the deal truly should be cash from the borrower. You can do 5% cash from the borrower and 5% as a seller's note, but then that seller's note, because it was part of the original use of equity, is on full standby for the entire loan of the SBA.
Yes.
So you've got a few things there that you have to look out for and you have to be careful about. But again, what are we buying? Are we buying just the assets of that business? Are we buying the name of the business? So a couple of things that I always want to do when I talk to a customer and you're going to be buying another business: why are you buying the business? What are the synergies with the businesses you already have? Do you have the expertise to do that? I always question the management background experience. If you're truly a restaurant owner and you've known that industry forever, you'd be hard to run a manufacturing company, right? Or vice versa. You know, the old story we always say is, an attorney looking to buy a bar knows how to keep himself from getting sued, but does he know how a POS system works? Does he know how to do inventory buys? Does he know how the ordering has to be done? Things of that sort. So industry experience from the management team coming in to buy is really important. Are you keeping any of the key employees? How are you going to retain them? What's your business plan? Are you changing up the whole model? Are you keeping the sellers on for up to 12 months? Because the sellers can't stay on longer than 12 months. Are they going to stay on and help you transition this over? Are you moving their location? Do you need the location? Do you not need the location? So, Paul, there's a whole bunch of questions, and this is where you start with the conversation. Hi, I'd love to help you. Tell me a little bit about the company you're looking to buy and why are you buying it? You need the story.
What you're doing then is taking each case on an individualistic basis, going down a checklist and seeing the strengths and the weaknesses and evaluating the borrower. Then you add into the business and then the seller's participation. Cover a little bit about the personal guarantee of the loan in place, as you just mentioned, by the borrower during the term of the loan. Did you mention, did I understand that correctly?
Right. So if you're the borrower and you've taken on an SBA loan, say you bought a company for a 10-year term, you have to provide a personal guarantee for the full 10 years or until the loan is paid off.
Understood. To facilitate protection, not only from the government, but the bank, so that you can't get a whole bunch of SBA loans and just disregard your obligation and accountability. You want the personal guarantees. That's understood. Now, when, as you mentioned a little bit earlier, rates are galloping forward and higher.
Yes.
To what extent does the SBA rate and the SBA term, say for a 7A loan, is that going to keep pace with the market as far as lending is concerned, or will they, as in the past, be under the normal borrowing rates from normal traditional lenders?
Now, so if you have a 7A loan and it's a variable rate loan and rates increase, your rate on your loan increases accordingly. So if you've got a rate in the month of June and we have a rate change in June, that next quarter, which would be July 1st, your rate changes accordingly. And then what they do is re-amortize out the loan under the new payments. But if you have a 25 basis points change per month, each month your rate's going to change accordingly because the rates are going up. Now, a bank, if they fix that rate, Paul, then you're in better shape as those rates start to change, obviously.
That reverts back to eligibility again and the comfort level in terms of the payback is concerned.
Correct.
A preferred loan would be different than somebody just walking in this off the street without attractive enough credentials to get that kind of status. The term of the loan in terms of months or years for a 7A, what are the ranges of payback on a term loan of 7A?
So the 7A, depending upon what you're using the loan for, so if it's commercial real estate and it's over 51% of total use of proceeds, you can go up to a full 25 years on a 7A loan for real estate, just like the 504 can go up to 25 years as well.
That's unusual because banks don't do that.
No.
So in the check column, go talk to Maggie. In the check column, it is the term period that doesn't give you crippling payment requirements in a condensed form as you would with a traditional lender. That's why the banks like it, because the government is guaranteeing it as far as the loan is concerned. Those are things that are really important for a listener to this podcast to understand, that you're not another face in the crowd with a different name than a bank, but the same as the bank. You're not. You're truly not. Good.
Correct. And these loans, the SBA does not like balloons. They feel that hurts the small business owner, and it can. So when we say it's a 10-year term, it's a 10-year term, 10-year amortization, full amortization, no balloon.
Yes.
If we do a loan for a building and we're 25 years, the term is 25 years, full 25-year amortization, no balloon.
Yes.
What's important that the business owners need to know is on these 7A loans, you need to be careful because there is a debt service requirement. So let me explain what the debt service is. That means your funded debt, your funded debt over EBITDA, it has to be at a certain mark to get the loan to begin with.
Yes.
But once your SBA loan is in place, unless you have a default, the loan really technically cannot be called. So it's really important for you to know that these loans are here to help these small business owners. They're not here to hurt the small business owners. Now, the 504 loan works really nice because it works in conjunction with a bank. So it's lowering the bank's exposure on these big pieces of equipment or commercial real estate. Normally in a 504 loan, the bank only has a 50% LTV, loan to value.
Yes.
So they've got a nice asset on their balance sheet, which helps the banks, right?
Mhm.
But then there's a 40% that's with the SBA under the CDC, Certified Development Company. And then of course you had the 10% equity injection that was cash from the owner. So Paul, that's really important to know for the small business owner, that you want the longer terms, you want the SBA loans because of those full amortization with no balloon payments.
When an owner, a private company owner, wants to add on, buy a product line or get some sort of financing, what should they be equipped with when they contact you for evaluation as to their lending eligibility? Financial statements, tax returns? Give us a little bit of a profile.
Sure. So anytime you're going in for any type of a loan, your banker is always going to ask for 3 years of business tax returns. They're going to ask for your interim financial statements. In other words, your year-to-date income statement and balance sheet. They'll ask you for a point in time accounts receivable aging report and accounts payable aging report. They will ask if this is a new line that you're looking to put in place, what are your projections on this new line? What is it supposed to do to increase your revenues and your bottom line profitability? What kind of profit margins are there? You as the owner, we're also going to ask for 3 years of your personal tax returns.
Yes.
And we're also going to look for a personal financial statement from you.
Got it. Okay. Now, I can't let you get away without asking, what's ahead in our economy? What are you seeing? What are the tank traps and speed bumps that we're about to encounter, aside from, of course, high interest rates and inflation? What else is in the kettle?
Well, I was just on a panel last week, Paul, with a bunch of very outstanding women. Sue Duckett, who is a factorer, Robin Ortello, who does equipment leasing, of all things that we were just talking about. I was talking about the SBA programs, and then Bryn Perna of Wintrust, who's part of their special assets group. We were talking about what we expect to see within the next couple of quarters. We're expecting to see the economy tightening. You're going to see a potential pullback from the banks on their credit policies as the rates start to increase. Because remember, Paul, when a small business owner went in for that loan and they were at these historic low rates, that was okay and their cash flow was working. But now as the rates can increase, your payments become larger, you're going to see the squeeze. So what does a small business owner do if the margins start to get squeezed? They either have to cut personnel, unfortunately, or they pull back, or they try to refinance, right? Or they want bigger lines of credit. We're also seeing the supply chain is still impacting so many of the small business owners still. We're seeing a little bit of improvement, but not much. But come the third quarter, we're going to see a tightening. And I'm anticipating banks beefing up their special assets groups and beefing up their SBA teams, because the banks are going to need to use the SBA programs to help mitigate risk as they're going forward to continue to lend.
So why not go to see Maggie now? Why go to the bank? Go see Maggie, right?
Okay, so you need your bankers right now. And remember,
Yes.
I am still a banker. I was a banker for many years, and I still consider myself a banker, okay? So you need the banks to help you. You need to have your plan in place. And there's a lot of banks that are still lending and are out there because they've managed their balance sheets well over the years. And face it, coming out of a pandemic, coming into high energy costs, I mean, we're anticipating gas to get up to $6 or $7 before the end of the year. I mean, that is not something we've seen in a very long time.
Right.
So we're anticipating the tightening of this market, but the smart business owners are the business owners who know how to manage their own balance sheets, know their product, know what their profit margins are, know how to run their business. They'll be able to maneuver well, but they should get in front of their bankers now to look at any loans that they have that are variable rate, any lines of credit that they need to extend, and to get things in place so that they're positioned well as we navigate the high interest rates coming and a tightening of the economy.
How can our listeners get to know you and contact you and get the fundamentals, meet with you, and see if they're eligible and how they might benefit from all of your services?
Okay, that's pretty easy. So for anybody who's trying to reach me, you can reach me at 708-804-8208, or my email address is M for Margaret, Griffin, Griffin, IN, at Somercor, SOMERCOR.com.
It's always a pleasure to talk with you, and you can set your calendar on sometime this fall, because I'm going to ask you a question now with just a yes or no answer, and then we'll cover it back in September or October. Is there going to be a measurable recession soon?
That's a really good question, Paul. With the tightening of the economy, I'm going to say we are heading towards the recession period of time. How long will it be? How strong will it be? How long will it go on? That I cannot answer, but I do think that we are going to see a pullback in the economy, and the steps that we're seeing now are showing indications definitely of a recession.
Maggie, thank you.
Thank you, Paul.
You've been listening to Maggie Griffin of Somercor. Talk with her, get to know her and her staff, and be prepared for a difference, something different than you've been experiencing in recent years as a business owner or a soon-to-be business owner. I'm Paul Heinze with Goldberg Heinze, and I hope you enjoyed this episode with Maggie. Let us know. Let us know what you'd like to hear, and we'll put on a podcast for you. Thanks for listening, and we'll talk to you next time.